Welcome to Beyond the Trees, a podcast presented by Cedarwood Financial Partners. I am the host and COO, Alex Murphy. Today we have a very special guest, someone I'm personally very excited to have on. It is Louis Diamond, the president of Diamond Consultants, one of the most respected and influential advisor recruiting and consulting firms in wealth management. Louis has advised on some of the largest and most transformative moves in the space, helping advisors, teams, and firms navigate the complex decision of where to build their business. He brings a unique perspective, not only on the full spectrum of models from wirehouses to independent RIAs, but also as a next-gen leader who stepped into the business his mother, Mindy Diamond, founded over 2 decades ago. Whether you're an advisor weighing your options or simply curious about the shifting dynamics in wealth management, you're going to want to hear what Louis has to say. Louis, I'm really excited. Thanks for joining us today.
Thanks so much, Alex. Been looking forward to this.
Awesome. On today's episode, we're going to walk through the full layout of wealth management world, breaking down all the different types of firms that exist, from captive broker-dealers to independent RIAs and everything in between. Louis, why don't we start here? Your mom, Mindy Diamond, built one of the most respected brands in the industry. Why don't you tell us how you came into the business, and was that always the plan?
Yeah, good question. So yeah, I sometimes jokingly say I got really lucky that I was selected to step into this business because my mom really just on a whim started her company and built it into what it is today. So basically gave my brother Jason and I, who today we co-lead the business together, the most amazing platform to now kind of do our thing and take it to the next level. So like our reputation is something that's earned. It's not something you can buy. And it took many, many years of doing the right thing for advisors to cultivate their reputation. And same thing with the brand. So just a quick shout out to my mom for what she built. But I came into the business 11 years ago. Time goes pretty quickly. I was a consultant in the financial services world for EY. I did some work with UBS and Morgan Stanley before that. But the short answer is no. I never ever thought I would do this. I was always the one who said I'm going to wear my own path and I'm going to do my own thing. And recruiting seems boring. I know it's created an amazing lifestyle for our family and it's a great business, but it's probably not for me. But I kind of got inception by my mom like 12 years ago. I was doing some projects for EY, traveling a bunch, and just it was kind of missing some of like the client connectivity, the entrepreneurial spirit. So I was explaining to her kind of my frustrations and what I was looking for, and she was like, you're just kind of describing like our business, and I think you'd be great at it. So I'm like, still, I don't think it's for me. Like, it's recruiting, it's not super sexy. Like, I want to do management consulting. I want to advise CEOs. She's like, well, we kind of do that. So she let me come to the decision on my own. But it was by far the best decision I ever made. And yeah, grateful to where I am now. I'm CEO of the company now. We just went through our own succession plan. So kind of eat our own home cooking with all the guidance we give around succession to financial advisors, and really excited about where we're taking this company going forward.
Yeah, that's amazing. I think oftentimes when you come in not expecting to ride the coattails, it turns out a whole lot better. And, you wanted to make your own way. Your mom just happened to make a phenomenal way, and it seems like a perfect fit from my side. And I'll say, for our listeners' benefit, we used you guys when we were looking to make a change. Couldn't be happier with the experience. And candidly, I have listened to your podcast and learned a tremendous amount. For me, we really wanted to learn a lot about the industry, and it was really hard where we were because it felt like you were blinded a little bit. And so between your podcast, Michael Kitsis, we really dove into, let's learn as much as we possibly can about everything in wealth management. And between you and your mom, really helped us a lot.
Thank you. Well, to be mentioned in the same breath as Michael Kitsis, that's a first. So I appreciate that. Yeah, he goes 10 levels deeper than we do. And I learn a lot from him as well, even though I'm not a financial advisor.
Yeah, I think he goes 10 levels deeper than just about everybody.
Yes, that's very true.
Well, so switching back to your transition, how has that been from a practical sense? How has the transition looked emotionally, practically, professionally? Is your mom completely out now? Somewhere in between?
Yeah, so it was a process. I mean, like any article you read about succession in our industry says it's a process, and kind of just agreed with that. But now I've seen it firsthand that it was a handful of years where we kind of knew this was where it was headed. I was a little bit surprised, and I didn't have an ego about it that it happened when it did. I was just like, eventually one day when I'm 50, it'll happen. And I didn't really have any expectation around it. So when my mom came to my brother and I and kind of shared what she was thinking about, we embarked on is probably a 2 year process. I started at Diamond Consultants like everyone else did, just cold calling, working with advisors, like no title, just kind of working my way up. But I was surprised with how just becoming CEO, how much of an impact it's had on me personally. I was like a little bit numb to it. Like I knew it was happening. I was president before, and I'm like, it's like nothing's going to change. I'm kind of already doing the job already. Like I don't really care about titles. I'm not an ego guy. But what I found was like almost immediately, it just gave me permission to think bigger, to think strategically, and to do different things. Not that I couldn't before, but just kind of having that like tacit permission to lead was pretty important. So my mom now, she's not retired. She's our executive chairman. She still works with select advisors and is still very active in our strategy and our marketing. She still does the podcast with my brother and I think that'll continue for a while. Like she's very happy with her role, and we love her expertise and guidance. So however long she wants to give us in the current capacity, we will more than take it.
I love that. Yeah, and I apologize. First, I know you said that titles aren't important to you, but I did say president in the intro. CEO is the fitting title. So anyone listening,
I
make
didn't
sure you get
correct
that.
you because, like I said, it's not that important to me.
Well, and it's interesting because I do feel like in a lot of firms, president and CEO are a little bit interchangeable in how they're used. So, regardless, my
And
apologies on
honestly,
that.
it is for our firm. My brother Jason is president of our firm, but we legitimately run the company together. So it really makes no difference to us, and I would kind of agree. Like I think textbook wise, the CEO kind of crafts the strategy and is ultimately accountable to it, and the president actually carries out the strategy. But we both are player coaches. Like we both still work with advisors. It's our favorite part of the job. We both kind of run different elements of our business, and we make every decision together.
It's amazing. So, with you both being next gen leaders that's kind of a poppy word at the moment to say next gen, but what are you doing to modernize the business? What have you changed?
Question. Um, So we've gone through 2 CRM conversions in the last few years. I wouldn't recommend it to anyone. It's super painful, but just looking at different ways to make our team more efficient. And because so much of our business is connected to our marketing, both from a lead generation standpoint and growth standpoint, but also from like our differentiators, thought leadership. So we needed a tech platform that connected our contacts or our CRM with everything we do in the marketing side. So that was I guess it was two things, but so two different CRM conversions. Guess I picked the wrong one the first time. And now we're on one that we like a lot. And then also another buzzword, but AI. So like I think everyone within our firm, like everyone in the country or in the world, like kind of dabbled with Chat GPT and AI. But we spent a lot of time and money basically coming up with a cohesive way for us to use AI, but to protect our data privacy and to use it in a way where like ultimately our process it can't be robotic. People work with us because of us. If people just wanted to know an answer, they can go on Google or ChatGPT. So basically, figuring out a way, probably similar to financial advisors, of how to use AI to drive efficiencies, make us better, and kind of keep us fresh and current, but without making us robotic, without our voice going stale. And so that those are probably two of the biggest things recently.
Yeah, that makes a lot of sense to me. I think, well, for one, you're speaking to my heart on the CRM because we're going to go through a new transition and learn a new CRM in a little over a year, right? So our staff, I'm sure, are looking forward to that. But at the end of the day, if it improves our efficiencies and makes us better, then it's great. And same with AI. I think the specialized AI that's coming out is really giving us opportunities as it is with you just to streamline and make our
Yep,
work more efficient and not replace people, but give them the ability to do more advanced work.
I agree. Yeah, that's the big thing. I think no one knows where it's going to go. Like my But my role in the industry is similar to financial advisors. Like, I mean, you could see a world where AI can replace it, but like, I don't necessarily think that's the case because, I mean, maybe robots will have empathy and maybe robots will be able to think creatively and outside the box. But ultimately, people work with us not because we can introduce them to Raymond James or to Schwab or to whoever. It's because of our expertise that we've built over almost 30 years in business and just our ability to be a thought partner to advisors, to show empathy, to help drive a process, and ultimately to negotiate for them. So I think both of us like have to use AI to make us better, to make us faster, to make us more efficient, but and just always kind of be sh- sharpening our skills. Because if we're not, then someone or something can likely do it faster and cheaper than it is to work with us.
Yeah, you're right on that. And so, with that, you are, as you say, platform agnostic, which I think is important. From your standpoint, how do you stay where you are objective? And, you probably have your own feelings of if you were an advisor where you would want to land, but it's important, I think, for you not to have that stance walking into a situation. How do you stay in that space of being agnostic?
Yeah, it's a good question. Yeah, I mean, we teach all of our team, and my mom taught it to me that like we ultimately have to be consultants. So we might have a feeling or an opinion. Um, Plenty of times advisors ask us for our opinions, but ultimately we're not the ones who have to transition, live with the decision, look our clients in the eye, and explain why we made a certain decision. So our job is to ask the right questions so that advisors can come to the right decision on their own. And with us, and you guys probably went through it, we start everything with our self assessment. It's kind of become our thing. So it's basically 20 qualitative questions we ask every advisor we work with to really understand what's driving them, what's motivating them, what their goals are, et cetera. And then we match that up with over 500 different firms that we have relationships with. So I think that's how we retain our objectivity. I also know that that's our value proposition is that like there's no barriers of entry to be a recruiter or a headhunter. You don't need a license. All you need is an internet connection, and any firm is willing to give recruiters a contract because they only pay them if they're successful in delivering quality candidates. So a lot of firms like they do have bias. They do send people to where they're going to get paid the highest fee. They do send people to basically what's easiest. Like most recruiters have like 2 to 3 firms they work with, and everyone's getting pitched a certain flavor of the same thing. We took a different approach, similar to financial advisors being open architecture. Like that's been my ultimate charge the last number of years. Is I want to have relationships with and know every single possible quality firm in the industry. So we're lucky. We probably get 10 firms a week reaching out to us, wanting us to help them find talent. I'd say we turn down 97% of them, and we'll speak to 3 out of 100 because we just know how competitive it is. So that's kind of how, in part, we stay fresh. But I read a ton, go to industry events, and just this, if an advisor shares with me a certain firm they're interested in or they're curious about, like instead of just selling against it because I'm not aware of it, we'll take it upon ourselves to reach out, learn about it, forge a relationship, and that's ultimately how we learned about some of our top clients today. Was just an advisor in passing mentioned it, and that was kind of the catalyst to learn about it.
That's fascinating. I think, from my perspective, that approach makes so much sense because at the end of the day, if your clients are happy, they're way more likely to talk about you. If you're shoving everyone in the same hole and is a square peg in a round hole, a lot of people aren't going to be happy.
It's also honestly, selfishly, it's also just it's not fun to do that. The most rewarding transitions we work on are the creative ones where someone had like a really unique need. Like I was talking to a group today who they want to form a joint venture with the life insurance company and there was like 5 different things. And I was like, well, I might not be able to find it, but I will try. And if anyone can figure it out, I'm confident that I can. Like those are the best transitions when we can come to advisors with solutions and options and types of options that they never would have thought of on their own. Like, I mean, our business when my mom started it, like it was fairly cut and dry as far as who the options were. It was Smith Barney, Merrill, Payne Weber, Wachovia, And that was pretty much it. I probably missed a firm or two, but like no one was going independent. Like the Ray J's and RBCs of the world were established, they were in business, but they weren't really attracting the types of advisors we worked with. So as the complexity has really increased across the industry, that's been kind of our prompt that we have to not only meet the complexity but rise above it, because ultimately advisors work with us to make the complex simple. Similar to why a client will work with the financial advisor. Like anyone can open up a Schwab self-directed account or go to Vanguard for an 8 basis point ETF portfolio, but people work with advisors to kind of rest easy that everything's taken care of, they're not missing anything, and that you can help them kind of wade through all the jargon out there. So I kind of again draw a parallel to what financial advisors do with how we run our practice.
Yeah, that makes a lot of sense. I think utilizing your expertise and experience is invaluable there. So, transitioning, using your expertise and experience, one thing I want to do for our listeners is I feel like the industry's rapidly changed over the last, 14, 10 years. And people don't really understand the difference in everything that's out there. They think it's either you're with a wirehouse and you're captive, or you're completely on your own
Yep.
and it's a wild, wild west. Could you give us some color on both ends of the spectrum and then everything in between,
Yep.
the best that you can?
Definitely. Yeah, there's so many like I try to bite my tongue sometimes because advisors even like just some of the jargon they throw out, I'm just like, that's not accurate, but like it's fine. It's not important. I'm not going to correct you. Like the number of times people say like RBC is a wirehouse, which is not. We consider it a regional firm, or Dynasty is an aggregator. It's not. It's a platform provider. Or Mariner is a roll up. Like there's maybe that one's true, but not really. There's a lot of just I think difference in definitions. What we try to do, we try to create kind of a common, basically a common language for how we would break down the different buckets in the industry. So it's changed. It's on our website. Anyone can look at it, but we basically break down the landscape of the industry into a horizontal line. I think when we first started doing this, to your point, like 10 years ago, there was like 3 or 4 buckets. Now I think there's 8. I can argue there's probably more like 10. So you
Wow.
have the wirehouses, basically the big four, UBS, Merrill, Wells Fargo, and Morgan Stanley. Then we have the regional firms, so still W-2 models. So it would be like Raymond James and Associates, RBC Wealth Management, Ameriprise, Stifel, Janney, Baird, Oppenheimer. There's probably a couple of others, but all still W-2 firms. Then we have the boutique firms, which used to be Lehman and Bear Stearns and Deutsche Bank and Credit Suisse, that have all gone away. So what's kind of slid in there is firms like Rockefeller and William Blair, JP Morgan Advisors. Um, then a newer bucket that we've kind of created is basically called the private equity backed RIAs. So that's the big national RIAs, typically backed by private equity, that are either acquiring a practice, whether they're coming from a wirehouse or otherwise, or buying an RIA. But it's more of an integrated model where advisors are W-2, they're most often partners, and they get the infrastructure of a firm, and they don't have to go out and build something on their own. And then everything else, probably there's 4 or 5 different ways to be independent. So you can join a independent broker dealer like LPL Financial or Raymond James or Cetera or Kestra, and be a 1099, get a deal, operate the business the way you want to. But kind of a corollary to that would be a firm like yours, which is a support structure that sits on top of an independent broker dealer that kind of gives the extra level of service and support that an advisor might want. And there's, so we call it supportive independence. So it's firms similar to yours that take an advisor who is entrepreneurial at heart, but doesn't necessarily want to find real estate, worry about compliance, build a website, set up benefits, manage HR, map over their book of business. There's thousands and thousands of things where advisors pay a fee to a firm to help them establish themselves as an independent, and then ultimately outsource a bunch of functions to that entity. And then you have kind of call it the wild wild west, which would be more of I want to build my own RIA from scratch. I'm going to go to Schwab or Goldman or Fidelity. I'm going to do compliance. I'm going to pick every piece of technology. I'm going to handle the CRM. I'm going to handle the planning tool and get the highest payout, but also sign up for the most amount of work and complexity. Along that spectrum, there's a lot of firms that have kind of like they play in multiple categories. Like LPL or Ray J, can probably put them into 4 or 5 of the buckets. And there's a blurring of the lines, for sure. If you look at like a stored partners, they have a 1099, they have a W-2, like it gets confusing. So we just try to stay on top of it and try to, whether it's fair or not to all the firms that kind of fall in the different categories, just try to make it as simple as possible. Because our belief is if you can understand kind of the different buckets or different disciplines, then you're probably 90% of the way there. And obviously, there's differences between the value propositions of RBC versus Stiefel versus William Blair. But if you kind of understand the bucket that they're in and kind of what that bucket means and what it stands for, at least you can kind of make heads or tails about their offer.
Yeah, it's beautifully done. I think if you can find the bucket that you feel like you want to be in, then you can dive into the
Yeah,
specific options within that bucket. But it and so often, even for firms that are the same, in my opinion, when you look at payout as an example, they'll give you numbers and it's not apples to apples
yeah,
ever. You're never looking at exactly a clear understanding of so what's actually hitting my pocket at the end of the day.
yeah,
And so I think that's where you can bring a ton of value too. I'd love to go a little bit deeper first in the captive broker dealer space. So,
yeah.
what's the appeal of staying there today in your mind, and what are the key trade offs?
Yeah. So I mean, there's a lot of industry press about, oh, like the wirehouses are going away and they're a thing of the past and everyone's going independent. Like when we look at the data and just anecdotally, like I don't believe that. There's still a massive, massive place for, as using your words, the captive W-2 models, whether it's the wires or it's firms like Ed Jones or RBC or the W-2 sides of Ray J or Ameriprise is an example. What advisors get is they get a brand. Like those brands mean something to the advisors. They often mean something to the end client. And each brand kind of has its own connotation or perceived way to target clients. Like whether it's the UBS private wealth brand is the gold standard, making it up to attract ultra high net worth clients, or my clients really resonate with Jones because I'm in a small town in the Midwest and that it's kind of just what people know. So I think brand's a big one. I think the overestimated part and what advisors take for granted is the amount of support that they get from these firms. Like, sure, they're paying a lot of money for that support, 50, 55, 60 cents on the dollar for that support. But for the most part, they don't have to take care of anything. Like they have to manage their clients, manage portfolios or outsource them to the firm, but they don't have to worry about the toner and the copier, business cards, compliance, HR, employee benefits, payroll. There's so much that these firms take care of. And I think it's why advisors who are captive at these firms most often have a very high growth rate. Part of it's the culture, right? It's a sales driven culture, eat what you kill, and you have the camaraderie of the office. And I'm number 7 in my region and stuff like that. But I think a big part of it is advisors can just be advisors. And for many folks, that's what they want. Like even if some people think moving from Morgan Stanley to UBS is lateral, um, for some people, there's a big difference, and they know where they're successful. And working for a more boutique firm, this example, but still having all the resources and a global brand is extremely appealing. So I think those are the biggest things. Like obviously, economics can be part of it. Like the W-2 firms pay bigger recruiting deals. That obviously solves for a lot of things for a lot of people. But I think outside of money, which is obvious, it's brand and it's all the support that advisors get.
Yeah, I think that was well said. So, for information for the listeners, where would, as far as payout goes, where do they finish as far as being the strongest, highest payout, lowest payout, somewhere in the middle? So those wirehouses, those big BDs, where do you see them landing?
So it obviously depends upon the firm, but more importantly, the size of the practice. Like any firm in the industry, larger practices get a higher payout than a smaller practice. I would say, like on average, if you're a captive W-2 for any of those types of firms, your grid payout's probably somewhere between 40 and 52%. Um, the big nuance and difference though is like the wirehouses defer a decent amount of their compensation, kind of the proverbial golden handcuffs. So your grid rate might be 50%, but 15% of your total compensation is in a 5-year cliff vest. So if you leave, you forfeit those monies. And obviously, time value of money and compounding is in play. But the bigger thing too is how much support staff are those firms covering? Like some of them, they'll cover all the support staff, and basically they like what the grid is what an advisor is going to get. Most times I see though, that either advisors are paying for an additional person or two, or the firm might pay 70 grand for an assistant, but they bonus them another 40 grand. So the true net payout is always is always the question. And like advisors often come out of pocket to cover client entertainment or marketing, or hey, this expense is just it's a nuisance to submit it, or I kind of went over my allowance. So it's hard to know kind of what the true net payout is. The best way I've seen for advisors to really know what the real payout is to compare their W-2 from the firm with what their GDC or their trailing 12 is. And then you divide the W-2 by your trailing 12. And it definitely doesn't take into account like 401k contributions or matches or payroll or not payroll, health insurance and things like that. But you can at least kind of get a close approximation. And that's what you can take to try to make it apples to apples to what the net payout would be as an independent, for example.
Yeah, I think that is a great point. That's where I always whittle it down to is what's hitting your bank and,
Yeah, that's
minus
what
tax.
matters.
Yeah. So you mentioned independence. So transitioning then to independence. First, I guess, can you illuminate what a transition deal is, what the purpose of it is, what they're kind of looking like in today's world, and then transition to payout and that how that looks, as well as maybe the support that you get at,
Yeah.
whether it's an LPL or Ray J.
Yep. Yeah. So you're talking about transition deals on the independent side
Yep.
or overall, just on the independent side.
Yeah, well, you're welcome to say overall if that's easy
Mhm.
enough to explain. Yeah, that'd be
Sure.
great.
So I would say overall, if let's say it's a $1 million advisor, so not the biggest, not the smallest, someone that firms want, and they don't have banged up compliance history, they're mostly fee based, et cetera. That same advisor can probably look at a 3 to 3.5 times or 300 to 350% recruiting deal from not all, but some of the captive W-2 firms. Some would be higher, some would be lower, and not all of it's upfront. Maybe half of it's upfront, and then the other half or so is earned based upon portability and growth. So that's a big number. On the independent side, it's much less. It ranges from zero. Like there's plenty. If you go start your own RIA, you're getting zero. Maybe you get a couple hundred grand from a custodian to offset some expenses, but it's zero. Or if you affiliate with certain RIAs, you get zero. But for the most part, with the independent BDs, the deals have really gone up. But I'd say this $1 million producer can probably see a deal between 70 and 120% of their trailing 12 or of their GDC. And then some firms would use, instead of looking at GDC, they look at assets under management and will put certain weightings on the type of business it is. Like on platform advisory, we get a higher multiple, say 70, 80, 90 basis points versus brokerage or TAMP business, we get a zero multiple or a much lower one. So the deals, even over the last like 5 years, I'd say have almost doubled. And we've seen them go up even more with LPL's acquisition of Commonwealth. That was like Commonwealth was the gold standard firm. So when suddenly 3,000 advisors or so that have very high quality books of business are in the market, it really made every firm that's competitive to LPL dramatically increase their recruiting deals. In some cases, increase their offers by 50%. And right now, at least, those deals seem to have some staying power. I don't know how long, as we record this in August of 2025, those are going to stick around for. But for right now, dependent recruiting deals are by far the most aggressive that we've seen them. And I don't think it's sustainable to keep them at these levels. And I don't even think that there's an opportunity to increase them. But it seems like right now, like the markets, knock on wood, are cooperating. Like interest rates are in a good enough spot for these firms to still make money on net interest margin and cash sweep. And just the competitive dynamics are so intense that any firm that really wants to grow by recruiting, fill in the blank of who it is, they know they have to really step up as far as their deals to even be taken seriously.
Yeah, it definitely changed the landscape significantly when that LPL Commonwealth deal came through, and especially with it being high quality advisors, like you mentioned. I think we'll see. I agree with you. I don't know if it's sustainable, but it's been interesting to see. And even from 3 years ago, the numbers are significantly different.
It's more. I mean, in fairness, the deals have gone longer. Like the typical independent recruiting deal used to be 3 years. and then it was 5 years for a while, then it was 7, and then it was 8. Now kind of the norm is 10. I've seen some go to 11. So obviously if the firms can increase the length of the deal, that's part of it. But it's also just, again, the competitive dynamics. Like it's why RIA valuations are so high, or any valuation for any practice is so high, because there's so many firms that want to that want to grow, and it's tough to grow organically. So if you want to grow inorganically, meaning to acquire or to recruit advisors with books of business, you have to come to the party with a big checkbook if you want to be invited in.
Yeah, no doubt about that. So something you had mentioned that I think is interesting to highlight is fee-based business versus brokerage commission business and how it's valued within the industry. Can you just quickly touch on that? And, if someone's looking, for example, to sell their business, just give them an idea of how that impacts the value of their business.
Yeah. So the answer is it could have virtually no impact on the valuation, or it could have a massive impact. So I'll explain what I mean. So if a business, which is rare these days, is all commission based, one, you're not going to find that many buyers, but also the valuation is it's probably a quarter or less of what a fee based book would look like. But if you have a business that's 90% advisory, 10% are legacy trails from annuities you sold 15 years ago. As long as the firm buying the business has a broker dealer affiliation or is a broker dealer, I would argue that the valuation would be the same if it was, or similar to if it was 100% advisory. Ultimately, a buyer in a transaction, whether it's a private equity sponsor, it's a strategic buyer, it's a local practice, it's your best friend. Ultimately, what they're buying is upside, and they're also weighing the risk. So fee-based business tends to be there's less disparity in the earnings from year to year, and it tends to be stickier. Um, and it's the most scalable. So fee-based business definitely gets a higher multiplier. But I think some people are surprised that it's not that there's two different valuations on a business. It kind of all goes into the formula. And maybe it's a blended number where the firm's willing to pay 4 times revenue for fee-based business and 2.5 times for the commission business. So they'll present an offer at 3.7 times because that's how their math works out. But I think unless the business is very commission heavy, the valuations should still hold up relative to a fee-based business.
Yeah. So then you mentioned some valuation numbers there. What are you seeing as the numbers range that people should be expecting when they're looking to sell their business? High end, low end.
It's always a tough one. If you say
Yeah.
ranges to an advisor, they're immediately worth the top end of the range. So
Yeah.
you're worth between 1 and 20 times. I'm worth 20 times. But there's a lot of I'd say misconceptions across the industry about the value of practices. Like you read a CityWire article or an Advisor Hub article about Beacon Point selling to KKR for reported 23 times earnings. Some people read that and think, oh my God, if I grow my business, I can be worth 23 times. Obviously, that's not true. So it really depends upon the size of the business. Like that's the biggest determinant of kind of which end of the stratosphere you'll be on. So not surprising, a $1 billion practice is going to be worth a lot more than $100 million practice. Um, so it's tough to say. Most legitimate buyers would use a multiple of EBITDA or free cash flow. Most broker dealers or say internal deals within a BD or within a wirehouse, they'll trade at a multiple of GDC or trailing 12. I don't really know why, but that's just kind of how it works. So I'd say, to use my $1 million advisor example, $1 million advisor, mostly all fee based, is probably worth 3.5 times through 3 times their top line revenue, or probably 7, 8, 9 times their earnings. So 7, 8, 9 is a big range. Firms that can grow organically and can demonstrated growth, not just my large cap growth portfolio is up 27% this year, but my net new asset flows are repeatable and have a process. Those firms will trade at the higher end of the range. Same thing with the makeup of the team. So is it one advisor who's 78 and doesn't have anyone else within the firm? Or is it a 65-year-old lead advisor, even a 78-year-old lead advisor, but there's 3 next generation advisors who know the clients, who can step in and basically retain the relationships. There's a whole host of other factors like what's the profitability, what's the typical fee rate, what services are provided, is it planning based or investment forward, how are the portfolios managed, is it model based or is it single stocks where everyone gets a different flavor of a portfolio. Like they're all things that matter, But by far, the two biggest, I'd say, determinants of valuation is the size of the practice to figure out where on the spectrum you go, and then what's the growth rate to figure out where within your band you'll trade for.
A lot of variability there.
There
It's
is. And
it's
also, like with anything, like a competitive process yields a higher valuation. So, like, there's nothing wrong with advisors just selling to their buddy, or they got an unsolicited call from the corporate development guy at whatever RIA, and they'll probably get a good deal. But I've seen it where if we're running a competitive sell side M&A process, similar to advisor transition deals, we can typically see a 25 to even 40% increase in the ultimate valuation because, like, ultimately multiple offers means more leverage, and the more you can ask for without feeling like you're going to lose the deal, you can kind of trade deals off of one another, et cetera. So like the business matters, but also the competitive tension is a big part of it, and that's part of what we do for advisors.
Yeah, that's fair. And I think everyone's probably aware a lot of advisors are approaching retirement now. And so I'm sure you're being approached by a lot of them. How are you navigating that with them to say, okay, here's all of the things to consider, and then here's really what you should be considering?
Yep. Yeah, I mean, I like to be super real and honest with people. Like, basically, just like even in the first conversations, probably has lost me some opportunities. Just be like, look, from a buyer's perspective, here's what I think is going to be really attractive about your firm. But more importantly, here's some of the challenges or issues. Like, I was referred to a $400 million firm a couple weeks ago where there was a ton of trust business. The portfolios were ran by the founder who was in his 70s, didn't have kind of a next gen behind him. Every portfolio looked different. Like, that's a hard business to market because you're not going to find a lot of buyers that are interested in that business. So I think the biggest thing is just to be super honest about your business. Like, be objective. If I were buying my business, what would be the challenges that I would point out? Like, what would give me trepidation? What would keep me up at night? What are the risk factors? Like, those are way more important than our performance is great, our culture is amazing, we grow by 12% per year. Like, everything like that's important, but it's more important, I think, to know the weaknesses. Because if you don't flag it for yourself, trust me, someone will. There's millions of dollars at stake, and firms see a lot of different opportunities. They're really good at dissecting the good ones from the mediocre ones, from the bad ones. Even if a firm doesn't flag it as part of an M&A transaction, there's typically a QOE, or quality of earnings analysis, where the firms hire Deloitte or KPMG or a regional accounting firm to come in and really do almost like a colonoscopy on a business and get super, super in the weeds. And if the issues haven't been fleshed out before then, they'll be fleshed out through that analysis because it's basically like an audit over multiple years of a business.
Yeah, that's interesting. So as you come across advisors who are looking to make a move that aren't retiring, I guess let's transition back to them. What are the top three things that you're typically seeing them underestimate or overestimate with a change? What are those biggest, most important things that people are missing?
I would say on both the overestimate and underestimate is the amount of work it is to transition. Like, I've seen some advisors who are like, oh, like, no worries, like 15 days. Like, my clients, I have 30 relationships. They all trust me. Like, they're all buddies, like, super easy. No, it's definitely harder and longer than that. But at the same time, I've seen a ton of really savvy advisors who have pain points, who have a real, I think, legitimate motivation and legitimate case to make a change, just not do anything. They let inertia win out because they're so worried about the disruption and the amount of work of a transition. I mean, part of it is it serves us when people transition, but I'm always, again, trying to be honest with people, is look at it and say, 10 years from now, if we had this conversation and I said, your business has doubled, you're happy, you're more fulfilled, you own your own business when you couldn't before, as an example, would T plus 10 Alex say it was worth it to have 3 to 6 months of disruption and backbreaking work? My guess is 100% of the time, the advisor would say, sign me up for it. I'm down for it. So I think that's a big part of it is if you really have have the rationale that there's things I want to do that I can't do at my firm. I know I can serve clients better elsewhere. I know there's a platform that can give me more autonomy, help me grow faster, kind of take me to the next level. Like, you're selling yourself short as a fiduciary to your clients, and even as the fiduciary or steward for your own life, to let the perception, or it's real. It's not the perception, but let the amount of work stand in your way. So that kind of cuts both ways. I think another thing people underestimate, and is that it's a lot of work just to get educated. And some people spend way too much time in education and they'll be burnt out for the actual hard work of the transition because they wanted to look at 37 different firms and speak to 18 people at every firm. Like you don't need to do that. So some people, they'll just go with their gut. They'll kind of field the first call, get what they think is a compelling offer and jump at it. I think that's a miss because there's always kind of there's always things under the rocks that you didn't expect or you didn't know were surprises. And unless you really look at multiple options and compare them, you're not going to understand, is the 93% payout with a 5 basis point admin fee that whatever firm's offering me, is that good? Or is that not? Or, oh, I didn't know that it's a thing that you can't have discretion in retirement accounts. I'm making it up. So until you really see other perspectives from other firms, you're not really going to know these things. So again, kind of cheating, but cutting both ways is kind of not looking at enough things or not being thorough enough or being too thorough in a process. And I'll give you one more on the underestimate side, is people underestimate the strength of their relationships. Like so many advisors are stuck in their tracks because they say, what if my clients don't come with me? Or, oh, like Jimmy was referred to me by the bank and like his loyalties to the bank. Or I see all these tactics the firm does to retain my clients. Like, what if my clients don't come? Like, I mean, of course, there's exceptions to the rule, but like I would say convincingly, a good advisor is going to move 85% of their business at a minimum within 3 months. Most are probably more like 90, 92, 93%, sometimes more. The exceptions to the rule going both ways is either a business was inherited and it's been 6 months since you've had the relationships and you think they're all going to follow you, or all the clients were referred by the bank and you hadn't really cultivated the relationships in the same way as business that you developed on your own. But I've seen there's a transition we did a couple years ago where it was two brothers from Merrill. They ran an awesome business, like $1 billion business. They actually grew during the transition. Like 3 months after the transition, they were at 110% of AUM because they had multiple clients say, "I freaking hated the firm you're at." And we just didn't trust it. Here's 10 million we had in our Schwab self-directed account that we want you to manage. Or a client has a liquidity event in the process, or the market cooperates. So like, I think people anchor on like the real negative, which I don't blame them. It's human nature, instead of looking at the positive of saying, hey, if I can bring over 90% of my clients, like what makes me special or different from everyone else? And sure, I want 100%, but even if it's 90, that's pretty dang good. And potentially got paid to move, and I'm moving for the next 10, 15, 20 years. And within a year or less, I'll easily rebuild to where I was before I left.
Yeah, I think that's fantastic perspective there. And I agree. A business built definitely transitions better than a business borrowed.
Yeah,
But
well said.
oftentimes I do feel like people get stuck in firms that don't suit them. And do you think that's predominantly because they're scared of the transition? Or is it something else? Is it, fear of litigation? Is it fear? I mean, there's a few things out there that can scare you, right?
I
What do
think it's all of it. I mean, these firms,
you,
depending upon the firm, like I don't have any like qualms in saying some of the more say aggressive Kool-Aid servers would be firms like Edward Jones is notorious for instilling fear in their advisors that if you leave, we're going to sue you. And any firm that successfully gets a TRO is going to make sure it's front page of Advisor Hub, even though that one TRO represents probably 1/90th of the actual transitions that happen where advisors weren't sued. And the ones that do get sued in this example are ones that kind of deserved it. They clearly took confidential data. They did something out of bounds. They didn't follow their attorney's guidance. Sometimes if it's a big enough group, the firms will try to find something or make a mountain out of a molehill regardless. And it's nothing the advisor did. But for the most part, the folks that end up in litigation, they did something that they know they shouldn't have, or they were trying to gain an unnecessary and unfair advantage when they didn't really need to do it. So fear of litigation, depending upon the firm, is real. But I think the biggest thing is just I'm growing. I just had my best month ever. I have 8 huge clients in the pipeline. I have a business I could possibly take over in 3 years. My family's going on vacation. Like there's things like that that keep advisors in their seat because any change is really hard. But in this industry, the switching costs are so high, like higher probably than any other industry. It's new technology, new people. You have to resolicit your clients if you're allowed to solicit. You can't take data for the most part, depending upon the firm you're coming from. A new culture, everything's new. So typically, the human mind works. I've read books on this. If there's a lot of complexity, it'll default to just doing nothing because that's where inertia kicks in. So long answer, but I'd say inertia or kind of the how much I'm growing and taking a step back is probably the biggest thing that keeps advisors in their seats.
Yeah, definitely a lot to unpack there, but all valid and high quality. I think, like you said, change is something that everyone's scared of, anyways. And then you pack in some of those extra fears, and I'm very comfortable with where I'm at. I'm making good money. I'm getting trips.
Yep.
It definitely isn't easy, but I think when you learn from people like yourself that are experts, those numbers are real numbers. You didn't just come up with them, right? When you
Yep.
say 92%, that's from true experience, and high quality advisors should heed that and take it for what it is and realize that if they are high quality and they truly believe it, then they should be okay in a transition too.
Yeah. I mean, it's hard because like there's a famous article or study that came out of Merrill Lynch a couple years ago, or Merrill, that said that advisors who transition retain less than 50% of their clients, and everyone was like, "That is there's no way that's true." But they didn't disclose the measuring period. But it's so easy to poke holes in it. It's okay. You probably measured it 1 week after they transitioned, or you measured it based upon the fact that the ACATs were dropped and they committed to moving with the advisor, but the assets take some times to move. So people see stuff like that and they just immediately assume it's true. Or everyone hears about, oh, like Billy in Tulsa, like he got sued. He only brought over 25% of his book and every advisor just picked off his clients. Like that's typically the exception to the rule, but it's hard to know like what's true, what's not, and what's like what you basically what you should ignore. But I don't think it's like the Cold War saying. It's like trust but verify. It's kind of what it is. Like one person tells you their horror story. Talk to two more people. One person tells you it's amazing. Talk to two more people. Like you got to get multiple perspectives. And anything you read, you likely got to just have the lens of what else wasn't reported. Like what's the actual details behind this? What can't be talked about? And what about everything that went right that isn't as sexy as XYZ advisor is TRO'd and has $1 million settlement with their firm. Like that's what reporters want to write about. They don't want to write about another transition on a Wednesday of an advisor leaving one firm to go to the other, where they brought over 93% of their book and they're very happy about the move. Like, that's not what gets the headlines.
Yeah, I think we all know that positive news doesn't get the headlines too much
Yep.
anymore. And I think, like you highlighted there, an important question is who's reporting it and why?
Yep.
And if you dig down to that, then you oftentimes get the answer that is closer to the truth.
It's kind of cool. I'm seeing like Reddit. I'm seeing used a ton by advisors. Like, I don't use Reddit personally, but like, and obviously anyone can get a Reddit account and there's trolls and all that. But like, I'm seeing it as like a really cool way for advisors to get multiple opinions on something.
Yeah.
And of course, everyone has their bias and their agenda, but it seems like people are trusting of the community. Or if you look at like the comments on different articles, they sometimes are hilarious, but they're also could be pretty telling. You hear kind of a perspective and you can kind of guess what side of the field someone's coming from.
Fascinating. Not where I thought you'd be getting information from.
No, I,
Reddit.
I personally don't, but it seems we're hearing it more and more often from advisors.
Yeah, that's interesting. Um, so I appreciate all the time that you've given us today. One last thing that I'd love to hear from you is just where do you see the industry going? Where would you like to see Diamond Consultants involved in that? And, what does the future hold?
Great question. So I feel like over the next couple of years, we're going to continue to see a ton of movement. Like not necessarily a lot more than what we're seeing, but it's gonna be healthy, which is good. I think the industry on average turns over every 15 to 20 years, meaning like 5% or so of advisors change firms every year. I think that'll continue, if not accelerate. Like I think how firms embrace AI is going to be a big thing. I'm starting to see advisors now say, I want to use Jump AI for the AI transcription on meetings, or I want to use ChatGPT to write emails, or I want to do a marketing campaign using AI and I can't. I think that's going to be a big driver for movement. and
Uh,
firms that are staying ahead of the curve, investing in it, and also investing in the right tools and not just building their own that's going to become stale is going to be a big, big factor. It's also going to be really interesting to see the continued role, if any, that private equity has in the space. Like private equity, no matter what segment of the industry you're in, is a massive, massive deal. Like it's what's driving valuations for independent practices higher. I'd argue it's what's keeping recruiting deals in the W-2 world where they are and grow is because there's so much competition. It also causes different broker dealers to get sold and displace a whole number of advisors. So I think it'd be interesting to see, is there more interest going forward? Does it stay the same or does it dissipate because now there's a bright new shiny object that all the sponsors are interested in? That's kind of where I see it going in part. Probably talk about this for 2 hours. Where I see us going is becoming more of a full service consulting firm to financial advisors and wealth management firms. So we already do advisory recruitment. We started an executive search part of our business where we help firms find talent either without books of business or just non-advisors in general. But we're going to do more in the management consulting or strategic consulting side. We're going to do more with not investment banking. We'll say M&A advisory, especially for advisors breaking away from a captive firm. We'll do some consulting work with private equity sponsors and probably 15 things I don't see coming. But basically, the goal is to leverage our relationships and our brand and our connectivity to more robustly service the wealth management world at large.
that's fascinating, and I am excited to watch your journey because I've seen some of those evolutions that you've started to make, and I think they're really interesting. And if anything, if your business is anything like ours, we come up with a plan, and a year later we think, all right, maybe we need to make a change.
Yeah,
And it seems like those are the things that we do that are the most impactful as well. So
exactly. Hey, even having a podcast it's I know it's a lot of work, takes a lot of commitment. It's easier to not do it. But I'm sure it's one of the reasons that your group decided to pursue independence was to do stuff like this. So kudos to even trying something like this out and to have the success on the show that you're having.
yeah, appreciate it. No, we're excited to have valuable guests like you. And, at the end of the day, we're just trying to have some fun here and we'll see where we're at 10, 15, 20, 30 years down the road. But we've been having fun so far.
Good job. Keep it up, and we'll be sure to have some of your partners on our show so we can kind of turn the microphone around and hear more about your firm's story and evolution.
That sounds great. Well, I appreciate your time, Lewis. You brought so much value here today to everyone listening. And, I'm looking forward to a friendship. We should have a long time left in our careers. So we should get to know each other pretty well.
Sounds great. Thanks, Alex.
Thanks for visiting.